Louis Navellier is hyping up stocks from the MAGA Wealth Fund, and I reveal them here so you don't have to buy Louis's newsletter. Just keep in mind, this is all guesswork based on clues from Louis's publicly available sales presentation, and no paid or proprietary information is being given away here. There's lots of stocks to uncover, so we're just going to jump into things. This presentation is another that has to do with Executive Order number 14,196 from Trump, which makes mining easier and opens up land for mining. Here's the clues for the first stock to benefit from this executive order. Louis says, for example, one of these companies I'm recommending owns the only domestic source of a specific type of rare earth mineral that's critical for our military. The Department of Defense officially classifies it as a Tier 1 critical mineral because it's a key component of military-grade ammunition, flame retardants, missile systems, fighter jets, and advanced communications technology. Now here's the problem. The US imports 100% of this key metal from other nations, mostly from China. And as a result of this, Louis says, this company also already secured almost $2 billion in financing from the federal government. And Louis says, this little-known company also has plans to produce almost 500,000 ounces of gold per year in the first 4 years of operation. The rare earth mineral Louis is talking about is antimony, and the stock he's pitching is Perpetua Resources with their stibnite mine. Here's the top 5 things to know about this company, and after I'll tell you if I'd buy. First is stibnite, a strategic powerhouse. Perpetua is developing the Stibnite Gold Project in Idaho, which contains roughly 4.8 million ounces of gold and the only mined antimony resource in the US, a critical mineral for military equipment, grid storage, and batteries. The US currently depends on China and Russia for its antimony supply, making this project strategically vital. The site also offers the chance to restore a heavily disturbed mining area, giving the project environmental and national security relevance. Second is capital on the rise and dilution risk. The company recently raised $425 million through a public offering and a private placement, and it's eyeing up to $2 billion in debt financing from the U.S. Export-Import Bank. This shows growing financial support, but also raises the risk of shareholder dilution as more funding may be needed to bring the mine into production. Investors should be aware that heavy capital needs could weigh on the stock in the short to medium term. Third is permit secured, mostly. Perpetua has cleared major federal permitting hurdles, including a long-awaited record of decision from the U.S. Forest Service and a Clean Water Act Section 404 permit from the Army Corps of Engineers. However, Idaho's Department of Environmental Quality recently sent back the company's air permit due to concerns about arsenic emissions. This could delay progress if the company can't swiftly address those issues. Fourth is government-backed, but controversial. The project enjoys strong federal support, including over $80 million in Department of Defense funding and potential government-backed financing. It's also part of the Trump administration's critical minerals push. Despite this, the project remains controversial due to opposition from environmental groups and Native American tribes, especially given its history as a Superfund site. Fifth is long road ahead to production. Even with major milestones achieved, Perpetua is still a pre-revenue company. Construction is targeted to begin in late 2025, with production not expected until years after that. Investors need patience, as this is a long-duration play that could offer big upside if successful, but with real risk if delays or cost overruns materialize. Early mining operations are always risky, and Perpetua is no different. However, this one seems to be a little safer than most, because it's well-funded and backed by the government. I'd put this one as a borderline buy and consider a high-risk, high-reward stock. Here's the clues for the second stock. I'll also tell you about another company that's using a new technology to produce lithium, which is a key metal for the electric vehicle market and energy storage solutions. This company is getting fast-tracked because the US imports over 95% of its lithium needs, mainly from Australia, Chile, and you guessed it, China. This is a tiny company whose shares are trading for less than $5. Not a lot of clues, but I'd bet this is Standard Lithium. Standard Lithium uses a direct lithium extraction technology that separates lithium from brine much faster and more efficiently than traditional evaporation ponds. Additionally, their main operation is in Arkansas, and the stock is under $5. Here's what to know about this stock. First is DOE-backed breakthrough. Standard Lithium just secured a $225 million U.S. Department of Energy grant to build its Phase 1 processing facility in southwest Arkansas, a pivotal, non-dilutive boost that shifts the funding burden from shareholders to taxpayers while validating its direct lithium extraction DLE tech. Second is 99% recovery in DLE pilot tests. The company's field pilot finished with over 99% lithium recovery, exceeding design specs. Achieving such high extraction efficiency with brine from existing wells significantly de-risks the commercial rollout and strengthens confidence in scaling. Third is zero debt and modest cash runway. As of late March 2025, Standard Lithium reported $31.6 million in cash and working capital, with no debt, which is impressive for a development stage miner. Yet, large-scale construction and ramp-up will require fresh capital, and the current balance sheet offers limited runway until project revenues materialize. Fourth is joint venture muscle with Equinor. Its Smackover Lithium joint venture with energy powerhouse Equinor brings technical expertise, deep pockets, and industry credibility. This partnership helps de-risk execution, opens doors to policy and commercial support, and aligns Standard Lithium with a leading global energy player. And fifth is sector volatility and lithium price exposure. Standard Lithium's progress is tightly linked to cyclical lithium prices, which have plunged from 2022 highs and remain unstable, though some forecasts suggest stabilization this year. A sustained downturn in lithium demand or prices could delay project financing or damp investor sentiment. Standard Lithium peaked when experts overestimated EV adoption back in 2021. EV sales have cooled down, and demand isn't what was expected. So the stock has dropped a good amount, with more people opting for hybrids over EVs. This isn't a terrible stock, though. It's one I would consider if you think EVs will be more in demand in the future. Maybe a battery breakthrough will happen, and EVs will get longer range or charge faster. Here's what Lewis says about the third stock. I'll also tell you about a company that owns one of the largest undeveloped silver-copper assets in the US. He adds to this and says, this is a large, well-established company that grew sales by almost 30% last year. It has also paid dividends for 15 consecutive years. This sounds like Hecla Mining, and they have one of the largest silver-copper deposits in Montana. Here's the top 5 things to know about this stock. First is record-breaking Q1 momentum. Hecla delivered record quarterly sales of $261 million in Q1 2025, up 5% from the prior quarter, along with an adjusted earnings before interest, taxes, depreciation, and amortization of about $90.8 million and net income of $28.7 million, 0.05 per share. While these are solid operational gains, the stock dipped nearly 12% after the earnings release, signaling that investors may have already priced in high expectations. Second is cash flow versus working capital puzzle. Despite strong cash generation from its top-performing mines, Greens Creek and Lucky Friday, Hecla actually reported a negative consolidated free cash flow in Q1 due to elevated inventory and receivables. This suggests that while production is heating up, working capital demands may strain near-term liquidity. Third is deleveraging strongly underway. The company's net leverage ratio has declined sharply to around 1.5x from 2.7x just a year ago, underscoring successful debt reduction and improved balance sheet health. This transition enhances financial flexibility and may support future growth investments. Fourth is operating cost pressures. Cash costs and all-in sustaining costs have risen across major assets, Lucky Friday, Greens Creek, Casa Berardi, especially in Q1, driven by inflation and site-level pressures. While still within guidance, tighter cost control will be crucial to preserving margins as commodity prices fluctuate. Fifth is diversification and upside in growth projects. Beyond silver, Hecla is ramping up gold production at Casa Berardi and aiming to advance growth through its Keno Hill asset, which just reported its first profitable quarter. Still, external concerns such as slower production ramp-up or delays at Keno Hill and Casa Berardi may weigh on investor sentiment. Analyst coverage notes these are the next catalysts to watch. Silver and copper doesn't really excite me, to be honest, and because of this I personally wouldn't invest in Hecla. Lewis also has a bonus report with another stock unrelated to mining. It's called The Company Powering Trump's AI Revolution. Here's what he says about it. This company operates in Texas's Permian Basin, and then says, this company owns 43 natural gas processing plants and more than 14,000 miles of natural gas pipelines across the Permian. This is midstream company Targa Resources. Here are the top 5 things to know about this stock. First is midstream powerhouse with strategic footprint. Targa is a major player in the U.S. midstream energy market, specializing in gas gathering, processing, fractionation, storage, and transportation. Their presence in high-growth regions like the Permian Basin and Bakken gives them a strong growth trajectory, evidenced by record throughput volumes and recently completed infrastructure projects. Second is record EBITDA, yet earnings mixed. Quarterly results showcased record-adjusted EBITDA over $1.2 billion, an approximately 22% year-over-year increase, highlighting robust cash flow generation. However, disappointing revenue misses and lower than expected EPS in Q1 indicate that while the top line is growing, profitability has some operational friction that needs monitoring. Third is dividend hike with hefty payout ratio. Management raised the quarterly dividend 33% to $1, delivering a roughly 2.3% yield. While that's attractive for income-seeking investors, the payout ratio sits high, around 74%, meaning future hikes may be pressured by debt or capex demands. Fourth is manageable leverage, but debt issuances keep coming. The company maintains a hefty debt load with a debt-to-equity ratio over 6. Yet, recent debt issuances, $1.5 billion in senior notes mid-June were used strategically to refinance and fund growth rather than cover cash flow shortfalls. Still, interest rate risk remains a factor to watch. And lastly, strong analyst sentiment with price upside. Wall Street consensus is solidly bullish. 15 analysts rate the stock buy or strong buy, with an average one-year price target near $199, upside approximately 18%. Industry data shows momentum is building. Targa's relative strength rating recently climbed to 71, but it still trails breakout territory, suggesting more room to run if earnings stabilize and growth continues. Targa is a good company and one that you should consider buying, but it is becoming very expensive and bordering on overvalued. If you're looking for a midstream play that's not overvalued, you should consider Energy Transfer. And don't forget to click the link in the description to check out AlphaPick. Right now they're running their biggest sale of all time, and you can get $100 off this amazing service. Remember, I've reviewed over 100 stock picking services, and this is the only one that consistently beats the market, nearly tripling the returns of the S&P since inception. So again, make sure to click the link in the description and get $100 off this incredible deal.